Good day, this is Glennford as ATAY, and I will be presenting about assignment number 2 on what is credit and so on. So first and foremost, define and explain thoroughly what is credit. So credit is a financial arrangement in which a party or the lender provides money, goods, and services to another party or the borrower, with the agreement that the borrower will repay the value at a later date, often with interest. It is built on trust that the borrower will fulfill their repayment obligation. Credit plays a crucial role in facilitating economic activities by allowing individuals, businesses, and government access and to resources that they do not currently have or don't need to acquire in the future. So in historical context, the term credit originates from the Latin creditum, meaning a loan, thing entrusted to another, derived from credere, which means to trust, entrust, believe. This etymology underscores the foundational elements of trust in credit transactions. Next is describe the credit economy. So the credit economy refers to an economic system where borrowing and lending are integral part of financial transactions. In this system, credit enables individuals and businesses to spend beyond their immediate income or savings, thereby stimulating economic activity. For example, consumers use credit to purchase goods and services. Businesses use credit to invest in operations, equipments, or expansion. And governments borrow funds for infrastructure projects or public services. So a credit economy thrives on trust between lenders and borrowers, supported by institutions like banks, credit unions, and financial markets. So some economic theories, such as the credit theory of money, propose that money itself is a form of credit or debit or debt, emphasizing the close relationship between credit and monetary systems. Next is enumerate and explain advantages and disadvantages of the credit economy. So first is its advantages. First is increased purchasing power. Credit allows consumers to buy goods and services they cannot afford immediately, improving their quality of life. Next is economic growth. Businesses can borrow to invest in production, innovation, and expansion, fueling job creation and GDP growth. Next is flexibility in financial planning. Credit provides individuals and businesses with the ability to manage cash flows more effectively. Next is encourages investment. Credit facilitates investments in infrastructure, education, and technology that drive long-term development. So let's move on to the disadvantages. First will be debt accumulation. Borrowers may overextend themselves, leading to unsustainable debt levels. Next is high interest costs. Interest charges can make borrowing expensive, especially for those with poor credit histories. Next is economic instability. Excessive reliance on credit can lead to financial crisis if borrowers default on loans. And lastly, inequality. Access to credit is often unequal, favoring those with higher incomes or better credit scores. Fourth one will be to enumerate and explain the foundations of credit. So the foundations of credit are essential principles that ensure trust between lenders and borrowers. So first will be trust. The lender must trust that the borrower will repay the loan as agreed. Next is legal enforceability. Credit agreements are backed by legal contracts that protect both parties' rights. Next will be creditworthiness assessment. So lenders evaluate borrowers using the 5 C's of credit. So the 5 C's are character, capacity, capital, collateral, and condition. So in character, the borrower's reputation for repaying debts. The capacity, so the borrower's ability to repay based on income and expenses. Next is the capital, the borrower's financial assets or net worth. Next will be collateral, assets pledged as security for the loan. And lastly, condition, so external factors like economic condition or his industry trends. Fifth is to enumerate and explain the basic characteristics of credit. So I will only mention a few. First is deferred payment. Borrowers receive value now but agree to pay later. Next is interest obligation. Most credit arrangements include interest as compensation for the lender's risk and opportunity cost. Next is repayment agreement. Borrowers must adhere to set terms regarding repayment schedules and amounts. Next is risk involvement. Lending involves risk for lenders if borrowers fail to repay their obligation. Lastly, legal binding contract. Credit agreements are legally enforceable documents that outlines the rights and responsibilities of both parties. Next is what is a credit card and explain its advantages and disadvantages. So a credit card is a financial tool issued by banks or financial institutions that allow users to borrow funds up to a pre-approved limit for purchases or cash advances. Users must repay borrowed amounts either in full or through monthly installments, often with interest or on unpaid balances. So, moving on to its advantages. So, first is convenience. Credit cards eliminate the need to carry cash and are widely accepted globally. Next is reward programs. Many cards offer cashback points or travel rewards for spending. Next is it builds credit history. So responsible use helps improve credit scores over time. Next is emergency access to funds. Credit cards provide immediate access to money during emergencies. So moving on to the disadvantages. First is high interest rates. Unpaid balances accrue significant interest over time. Next is it encourages overspending. Easy access to credit can lead to impulsive purchases and debt accumulation. Next is fees and penalties. Late payments or exceeding credit limits result in additional charges. And lastly, potential for fraud. Credit card information can be stolen if not properly safeguarded. So into the last question, enumerate and explain classifications of credit. So credit can be classified into several types based on its purpose and repayment structure. So first of that is revolving credit. Borrowers have access to a set credit limit. So for example, credit cards and so on. Repayment replenishes available credit for future use without requiring a new loan application. So next is installment loans. Borrowers receive a fixed amount of upfront and repay it in regular installments over a specified period. So for example, that is car loans and mortgages. Next is open credit. Borrowers must pay off balances in full by the end of each billing cycle. So example of that is utility bills, electricity and water. Next is secured credit. Loans backed by collateral. So for example is home equity loans or bisag unsa lang loans as long as nag-need siya og collateral. Reduce risk for lenders but require borrowers to pledge assets. Lastly is unsecured credit. Loans not backed by collateral. So for example, personal loans. So kanang Um, it relies solely on the borrower's creditworthiness but often come with higher risk raised due to increased risk.